You're watching Beyond Markets. Welcome, I'm Esther Awoniyi. Many thanks for joining us. On today's show, we'll discuss the top risks to watch out for in Nigeria this year. We'll also take a look at the internal and external developments that could shape how the year unfolds. As always, you can join the conversation with the hashtag Beyond Markets. And you can follow my Twitter handle too at Esther O. Awoniyi. As businesses, individuals, and governments plan ahead for the year, we'll take a look at some of the key risks that they should factor into their planning. Zeal Akaraiwe, CEO, Graeme Blaque, joins me now for this discussion. Zeal, thank you so much. It's a pleasure to have you.
Thanks for having me.
Another year, and with it comes the usual risks that we should expect, especially for businesses. But let's take a couple of steps back to take a look at some of the risks that were forecast for 2018 and how they actually did impact on the environment, the business landscape, and how, as a country, as business people, how they were able to tackle them. And some on that list, some of the items on that list were currency risks. Before we then saw the Awoniyi window, of course. Political risk, not so much, but it was also forecast for last year. But just what comes to mind for you in terms of those top key risks that played out in 2018 and how it impacted on the business environment?
I'll say what played out in 2018 were not risks of 2018. They were risks from 2015 that just had a prolonged period because they were not addressed adequately. And so the period that they lasted was much longer than it should have. 2018, in my opinion, was actually much better than 2016 and 2017. The liquidity squeeze on foreign exchange had started to ease as compared to 2016. There was a relative stability of the currency in 2018 compared to the previous year. So 2018, compared to the previous 2 years, was significantly more positive for businesses. Unfortunately for us, that cycle has not quite ended, and we're jumping straight into the same cycle that started this whole brouhaha in 2015.
So are you talking about, because for the currency, before the CBN, the central bank created the Awoniyi windows for investors, when we had that supply deficit at the market, there were a lot of tensions in the market, but of course that ended well, in quote as well, but we still ended up with multiple exchange rates, which was still a concern for the likes of the World Bank and some investors. But we also had monetary policy. I mean, there was monetary policy uncertainty. That we kept our eyes on inflation, but luckily we saw that coming down consecutively. But you say that we're still seeing part of the risks from 2015, yes, 2016. And now do you think that we're going to see a bigger accumulation? What is that going to snowball into, as it were? Okay,
so let's discuss what exactly these risks are. In my opinion, there are 4 key issues that the Nigerian economy is extremely susceptible to. One is the reserves. How the reserves behave affects a lot of perception. 2 is oil price. Oil price and reserves are highly correlated. I would have said perfectly correlated, but in the last 2 or 3 years where we've used debt in one form or the other to show up reserves, but reserves and oil prices are highly correlated. Then you have the risk around policy, economic policy. Then you have the cyclical risk around politics, which is every 4 years. So every 4 years, the same thing happens, largely pre-election year for emerging markets. The same things happen. It's happened since Kingdom Come. It will not change. So all those things have converged. In 2015, they all converged. We had depleting reserves. We had very low oil prices, we had horrible policy instability, and then we had elections. Those 4 converged 2015, 2014, 2015. We started seeing the impact late 2015, 2016, and it was not good for the economy at all. This year, we have exactly the same issues and slightly worse. Slightly worse in the sense that on the central bank and economic policy side, the central bank governor's tenure ends this year. And so that throws in the risk of policy stability. Is he going to stay? And continuity. Yeah. Is he going to stay? Is he going to go? If he stays, what does it mean? If he does not stay, who's coming? What will that person do? All those uncertainties are at the forefront. Will the things he has done be continued? And that continuity for businesses with the central bank governor's tenure ending May, that's an issue. His tenure ends same month as potential handover if the incumbent doesn't win the election. Even if the incumbent wins the election, it's a new political cycle. So you have those two converging. Oil prices are weaker than the budget benchmark for this year. Reserves will have been depleting slightly, but they are still relative. I think they're still about 42 billion. So it's not so bad. So all of those things coming together at the same time, the way these risks and these issues are managed is a lot more important than the issues themselves. And historically, our management of these issues has left a lot to be desired.
So as for CEOs this year, business CEOs, how do you see them interpreting how these events are going to unfold? If we're talking about currency, the Naira thankfully has been somewhat stable. But we have heard predictions that we could see, we cannot run away from the fact that the likelihood of the Naira softening or weakening from somewhere around 365 where it is right now, to somewhere around 390 at the end of the year. We have heard that so many analysts that I've spoken to have said that they actually expect that to happen. You've mentioned oil price, and of course we know that the CBN may put in more energy in trying to defend the Naira this year. There's that possibility. We don't know if that's going to play out, but there's that possibility. So for a businessman, asking himself, so how do I play this environment when there's the possibility that the incumbent could return, may not return? So I'm just wondering, there's just so much uncertainty. So what direction do you see business taking?
For me, I think the other thing which we didn't mention was that in the last couple of weeks, the central bank has spent a lot of effort in ensuring that liquidity is controlled. A lot of effort. And in controlling that liquidity, the theory behind it is that they're trying to make sure that inflation is curtailed, so they're managing liquidity. A lot of people have conspiracy theories around why they are doing that, but the point is they are controlling a lot of liquidity. If the liquidity in the system is constrained, controlled, whatever language we use, it's going to affect businesses. Businesses are going to find it more difficult to borrow. A lot of businesses live on debt. As a business CEO, I would not be taking unnecessary risks in terms of long-term views unless I am hedging my exposures. This is not the year to take a lot of risk that you cannot control.
Maybe for the first, would you say not take those risks until the political dust is settled, until after the elections, until we are certain we know who the next president is and what the policies, if there's going to be a continuation of policies, if it's the incumbent that comes back, or if we do have someone else?
Let me give you an example. The currency today is give or take 365. If I was a business CEO and I had an offer for a loan for 3 years at 5% for $100 million, that sounds like a good deal. Unless you can enter into a 3-year hedge on your currency, because if the projections by the analysts are correct that in 1 year we would lose 10% on the currency, it means potentially that loan in the first year will cost you 15%. 10% devaluation of the currency and the 5% of the cost, assuming the 10% is correct. And it could be 10 may be right, 10 may be wrong. I mean, we really can't tell, but those are the projections I've seen generally. So those are the kind of risks I'm talking about. Do you want to enter into a long-term contract where your foreign exchange risk is paramount? Do you want to enter into any type of contract or business venture that is very sensitive to policy, where you know the central bank governor's tenure ends in May, and he may not come back? We don't know. So those are the kind of things. If there's a new person, is he going to toe the line? Is he going to do things drastically different? If there's a new president, is he going to... You know what I'm... So it's all that uncertainty between now and the elections are next month. Results will be out hopefully before the end of next month. So we should have a good idea. The gubernatorial will be in March. We should have a good idea pending whatever, if there's any contest and all that.
But would you say CEOs, the business and community should be preparing for 1 or 2 scenarios, or 2-3 particular scenarios? Because for fiscal uncertainty or fiscal risk, 2 scenarios play out. For if the incumbent does come back, we know that as far as the economy is concerned, according to what analysts are telling us, the status quo will be maintained in terms of the currency, budget, the economic recovery and growth plan, which is the blueprint that this government has been using. We would expect that to continue. But if the main opposition from the PDP if he does end up becoming president, what we're hearing is that he has promised to deregulate the forex market and encourage privatization. So that's another scenario that we could potentially be looking at, or find ourselves in. So as a business, as a CEO, are you telling yourself, okay, let me look at or prepare for two potential scenarios that could play out this year, from one leader to another, or I don't know?
I don't think it's that is one aspect. I mean, the budget, we've looked at the budget. Budget doesn't really indicate that the environment is going to change for the positive this year, based on the budget that has been presented. And whoever wins, that's the budget we're going to run with. And so changing that is not as straightforward as we may like to think. However, as a business CEO, I would take a lot of decisions that can be hedged, in the sense that I would hedge my downside and know, okay, this is my worst case scenario, irrespective of what happens. If I can work on that basis, then I'll go ahead. The risk also threw up a significant amount of opportunity. Now, the question is, if you have the staying power, you've done your analysis, and you say, okay, look, I may get this right or wrong. If I get it wrong, you have a worst-case scenario, then I would take long-term risks. But regarding policy, regarding foreign exchange, I would be very cautious, and I would do if I were a business CEO in manufacturing or whatever, I would do everything on a hedged basis, especially with companies and businesses that run on very fixed margins. You don't want a policy, you don't want a foreign exchange risk to wipe out your profitability. So I would do that and hedge. It may reduce your profit margin, but it gives you certainty. And so that's what, for the first 6 months of this year, if I were CEO, that's what I would do. I would work towards certainty. Okay. Subsequently, you can take views, you can create the opportunities, you can decide to say, okay, in case this happens, there's this opportunity, keep your options open to be able to take advantage of them. But in terms of your day-to-day business on your fixed margins, I would hedge everything. Zeal,
we're going to take a short break and come back and pick up from where we left. So this time we'll focus more on external risks that could impact on our business environment. I've been speaking to Zeal Akaraiwe, CEO at Graeme Blaque Group. We'll continue our discussion right after this short. If you're just joining us, Zeal Akaraiwe, CEO, Graeme Blaque Group, is with me today, and we're discussing the top risks to watch out for in Nigeria this year. Thank you so much, Zeal, for your time so far. Let's switch over to the external risks now. We've been following very closely, that trade spat between China and the U.S., and it would appear what we're hearing from some analysts is that the U.S. is trying to have a quote, contain China policy. But of course, at the end of the day, they have to reach a good deal that's beneficial to both parties. And from what we're hearing from the White House, they may be close to getting a good deal. Hopefully, it'll be one that will be both parties will be happy with. But share your thoughts with us in terms of how that could potentially be a risk. That on the one hand, when one also thinks about the projection for global economic growth this year from the World Bank, somewhere around 3%. That is weakening growth. But let's hear your perspective.
I think the America-China thing is really delicate. Last time I checked, China was the largest lender to the U.S. And so China has vested self-interest in what happens in the U.S. economy. The U.S. knows this and understands this. A lot of things that are... China has become the world's manufacturing hub, more or less. And so whatever America does with China will affect the world. And I imagine they would have to tread very carefully. What I am concerned about is that America's president has not shown to be someone who is interested in treading carefully on any issue. And so it's really, really delicate as far as I'm concerned. As it affects Nigeria, last I checked, 20 to 25% of our imports are from China. And that's huge, that's massive. So there's a lot that the trade rift between the US and China is significantly more complex now than it was 10 years ago. Because 10 years ago, the Chinese currency was not, quote unquote, international. Now it is. After the global crisis of 2008, 2009, China made a lot of moves. They created a parallel currency. So you have the onshore renminbi and the offshore renminbi. The offshore renminbi can do a lot of stuff that the international currencies can do. The renminbi has been added to the international basket of funds. So there's a lot China has done because they want their currency also to be the international currency, just like the US dollar is. So any war could make that dream of theirs either much more achievable or much less achievable. But I suspect, given their positioning on global manufacturing, I suspect it to be much more achievable.
I know, right? China is fostering or trying to build a stronger relationship with Africa, the entire continent. We've seen massive investments, as you know.
I won't use the word relationship, but
massive investments into the continent,
yes,
by way of loans, especially much needed infrastructure.
Yes.
And so so Africa, I mean, the continent needs that machine to keep rolling or keep grinding, as it were. But of course, whenever China sneezes, I mean, there's a lot of countries, including the African continent, that could catch that cold if that happened. I mean, just this morning, the trade data came in weak, and we saw markets responding negatively to that. So I'm just wondering, going down the line, if the U.S. does pursue this policy of wanting to contain China, or just ensuring that, let's leave it at that, containing China, as it were, it would appear that antagonism may continue. It's not like they're not best of friends, obviously, but I just feel like we might continue to see that turbulent relationship continuing, and we don't know how that could impact on what's going to come up next. Today is a trade war. I mean, what's it going to be tomorrow?
So two things. One is, some analysts have said that America does not have an Africa policy. They have a counter-China Africa policy. China has a large population. I think it's about 1.3 billion, give or take. And China is a manufacturing hub and a consuming hub for the population. Now, if you're a manufacturer, what is most important to you is what? Raw materials. China does not have enough raw materials. Where are a large percent, I think 30 to 50% of the world's raw materials are deposited in Africa. Now, China is merely, in my opinion, making sure that they have unfettered access to the raw materials that they need to continue to be the manufacturing hub of the world. The infrastructure that they are developing in Africa is very well needed because Africa has refused, for whatever reason, to develop itself. They are not developing factories. They are not turning Africa into a manufacturing hub because that would be competing against themselves. They are giving us bridges and roads and rail, still consumer related. And in exchange, they are taking a lot of resources. So if Africa itself needs this infrastructure, which we do, and we refuse to turn ourselves into the manufacturing hub that we ought to, then we really would end up being at the brunt of the parable of when two elephants fight, the grass suffers. Exactly. So that's where Africa happens to have found itself. And I've not seen the concerted effort to turn Africa into a manufacturing hub. Nigeria particularly, we can never be a manufacturing hub if you do not generate power and distribute it efficiently. And so China has also been accused in a lot of articles of creating what is called a debt trap, creating exposure into the emerging markets that the emerging markets are unable to repay. And so in exchange, they take some dedicated resource or infrastructure and turn it into a China asset. That's been going on. They've done it in at least 9 countries, at least. And it's not, for them, it's your policies are generally against your own self-sustenance. If your counterparties do not counter that for their own self-sustenance, it becomes their problem. And this is where we find ourselves generally in Africa.
Share your thoughts on the World Bank's projection for growth this year. I mean, they've talked about weakening, especially for oil, weakening demand for oil. We know that could have ripple effects, especially for a country like Nigeria in terms of oil prices. We have a $60 per barrel oil price, a benchmark for the 2019 budget. I've seen projections as low as $45 per barrel this year. So slower global economic growth, risk or volatility in commodities, and obviously we're exposed to that as a country. Your thoughts on that?
Well, again, with the projections are what they are. It was, for the oil particularly, I would lean on the direction that would have slower oil prices for 2019, because very uncharacteristically across winter, oil prices dropped, which is very unusual. Normally across winter, demand for oil, heating oils and all that goes up. In this case, it dropped. So some fundamentals have definitely changed. And How long it will last, we don't know. But I think the lower oil prices is something that the world needs to come to terms with, and particularly Nigeria. Lower oil prices for us is not a good thing because we're still dependent 90-something% on our foreign exchange earnings on oil. We've been talking about diversification, but I think that the thrust and mindset around our diversification is inappropriate for what we need to achieve. And in terms of the global economy, what we're doing is, instead of diversifying, in my opinion, we are diversifying from one problem into the next problem. So we're moving from oil into agric. I think we should diversify across the value chain from production of raw material into processing. Because what we do right now is that we extract raw material, export, and somebody else processes it, and then we import it. We do the same thing in the agric sector. We extract raw cocoa, we don't process it, we add no value to it. We export it, and then we import the finished products. We do the same thing largely with tomatoes. If we diversify our resources into producing more and more agric, we're going to do the same thing. We're just going to extract the raw material, export it for someone else to process, and then import the finished goods. So we need to diversify into processing, and that means we need to take more interest in power generation. That is what would help us to insulate from the global issues, because you then become self-sustaining.
So, I mean, still on external risks, foreign direct investment, that is something that we obviously need to see more of in 2019. But of course, there's been talk about risks and what countries and what direction we could see FDI, turn into this year. Do you think that in terms of our chances of attracting concrete FDI, I'm not talking about foreign portfolio investments, proper investments into infrastructure, things like power, especially that you've just talked about. What are your thoughts in terms of what our chances are? Our
chances were very good, but we shot ourselves in the foot. We've done that multiple times, but I think where we took a bazooka and blew off our own leg was with the MTN issue. The way we handled it, we created a brand new risk that hitherto didn't exist in Nigeria. Foreign investors would bring in money, they would get legal opinions, asking what are the risks that if I take this money out, I would need to refund. Before the MTN issue, your legal opinions would generally tell you that risk doesn't exist. Once you have your CCI, once you take your money out, you're clean. That's how it works. But with the MTN issue, where the central bank went back 10 years to dig up issues, and you threw out a sensational, they needed to refund $8 billion. You later settled at 50-something million. That whole sensation threw up a brand new risk of the money I took out 5 years ago, am I sure next year or this year, when the CBN governor changes or the CBN policies change, how do we know as foreign direct investors that those issues will not be dug up as some infraction against some tax issue that was non-existent 5 years ago gets thrown up? So that's some risk we have now introduced, and there is no way it will not affect foreign direct investment negatively. How negative, I don't know. But people would generally be a lot more cautious to invest long-term in Nigeria because of this than they were before.
Zeal, we're going to have to leave it there. Thank you so much for your time today. We really appreciate your perspective. And yes, a lot of headwinds ahead, but fingers crossed on our ability to...
Two fingers crossed, legs crossed.
...adequately maneuver those headwinds. Thank you for your time today.
Thanks for having me.
Speaking to Zeal Akaraiwe, CEO, Graeme Blaque Group. That's our show for today. Thank you so much for being a part of it. But remember, you can watch all previous episodes of Beyond Market on our website at cnbcafrica.com. And you can also stay engaged with the hashtag Beyond Market. And you can follow my Twitter handle too at Esther or Awoniyi. From myself and the team, do have a great day.